Hello. Thank you for joining us today on the Profit Scale Thrive podcast, where we guide attorneys to overflowing profits, scaled growth, and thriving lives. I am your host, Kelly Brubaker. We have a secret though. This is a special place because we don't work with every law firm owner. We support the solo attorneys who are also single parents because we know the special challenges you face, and we know the business advice out there is not always practical for you and your firm. Each week, we will talk about things that will give you the insight you need to stop feeling overwhelmed, to gain back your confidence, and to finally enjoy your law firm and your life again. Hello, and thanks for joining me today for podcast episode number 8. Welcome back, or for those who don't know me yet, my name is Kelly Brubaker. I am a CPA and a business coach who supports solo attorneys who are single parents. I'm also a certified Profit First professional, which means I help my clients implement the cash management system presented in the book Profit First, written by Mike Michalowicz. So, a few weeks ago, starting with episode number 5 of my podcast, I began a dedicated series of podcasts to share with you in detail, chapter by chapter, the book Profit First. So if you've read the book, please follow along as I will share tips not in the book along the way. If you've not read the book, but you're curious about it, please stick around as we go through chapter by chapter. This week, we're talking about chapter 4, assessing the health of your business. Mike starts this chapter by describing how one of his first reviewers of his draft of the book Profit First was upset by this chapter, and for good reason. It's a come to Jesus moment for many business owners. And I don't mean to scare you, but please take this as a warning. This is an uncomfortable chapter. And my simple advice here is you need to decide whether you wish to struggle to find money to pay your bills, or if you want your bank account to grow and flourish to a point that you have a lot more freedom with your company and your life. So the almost instant assessment. The book refers to this as the instant assessment, and I sometimes refer to it as a profit assessment. Just so you know, these are the same things. Now, remember, Profit First is a cash management system, not an accounting or bookkeeping system. So accruals, depreciation, and accounts receivable do not matter because those are not cash. Those are accounting things. We are talking about real money only. Profit First is to identify when cash has been received, where you can best put it to work for your firm. The instant assessment is a form that Mike developed from interviewing thousands of fiscally elite and very profitable companies to guide you on how to best use the cash in your business. So to get started, you're going to need your P&L and your balance sheet. If it's easily available, I try to use the period for the last 12 months ended last month. So it's currently April 2023. I would normally use the April 1st, 2022 to March 31st, 2023 P&L and balance sheet. If it's not easily available, then the most recent 12-month P&L and balance sheet available is your starting point. Hopefully you have your bookkeeping up to date. The newest information will yield the best results, but you need a starting point. And keep in mind, this is something that you can do and will do periodically going forward. If your information is really outdated because your books are not updated, do not skip this step. Use ballpark numbers until you can get accurate information. So here's what the instant assessment looks like. It's on page 62 of the book, and hopefully that comes through on video. Otherwise, I have in the show notes or in my blog, I have a snapshot of what it looks like. And so it's a simple box, has several columns across and several rows down, and we're going to fill them all in with numbers from your P&L and balance sheet. But here's a side note. I created my own version in Excel of this instant assessment that I will link in the show notes and in my blog notes for this podcast, and it makes this step a breeze. So let's walk through this. To start with, we start with top line revenue. This is your total revenue from all sales in the 12-month period on your P&L. Total revenue may also be referred to as total income, total sales, revenue, sales, or net sales. It all depends on how your chart of accounts is set up in your books. The next line is called materials and subs. Many service-based businesses never use this line. For law firms, the only time I have seen it used is when you have of counsel relationships who work more than 25% of your caseload. This line is meant to track your raw materials and significant cost of outsourced labor, but only labor that is in place to generate revenue, and they are not W-2 employees paid through your firm's payroll. So if you have an outsourced receptionist, he or she doesn't generate revenue and they would not be tracked on this line. But here's the thing, do not overthink this line. If you're questioning what to put here, enter 0, move to the next line. So our first calculation is to take the first number, total revenue, and subtract your materials and subs, which again, for most law firms is going to be 0. The resulting number is called real revenue. This is the real tangible money your firm is making to operate on. This will not be an eye-opening number for most law firms, but for a business such as a retail store, this may be a shock because inventory would be included in the materials and subs line. For example, $2 million in total revenue, but $1.5 million in materials and subs would leave only $500,000 left to operate the company, not the $2 million that the P&L would leave you to believe. It makes a big difference depending on the type of company that you are. So please note that while materials and subs seem comparable to cost of goods sold that you typically see on a P&L, and real revenue seems comparable to gross profit or gross margin, they are not the same. Not the same for profit first purposes. There are subtle differences, but remember our overriding principle is to track your actual cash in and out in a simple way. That's it. Next, set aside your real revenue number for a moment and let's look at your remaining numbers. So for profit, look at your balance sheet, go through your distributions. How much have you, and your cash account, I'm sorry. Those between your cash account and your distributions for the 12-month period on your balance sheet, how much do you actually have sitting in the bank or have distributed to owners over the 12 months as a bonus on top of salary? We're not talking about distributions that are meant to be compensation. On top of salary, how much profit have you allocated? Next number, owner's comp. How much did you actually pay all equity partners of the firm for payroll? For tax, how much money has the firm paid of your tax bill? This is all taxes the firm paid for the firm itself if the firm owes taxes depending on your corporate structure, and all equity partners personally. So if you pay your personal taxes through your W-2 paycheck or you wrote a check for your tax bill from your personal checkbook, then this amount is 0 unless the firm has taxes of its own. I'm in Ohio, we have local taxes. So regardless of whether you're set up as an LLC, a partnership, an S Corp, every law firm has local taxes, depending on their address, if they're located within a city limit. But again, don't overthink this. If the firm wrote a check directly to the IRS, your state, or your city for taxes, put that amount in here, regardless of whether it was for you personally or for the firm. And then lastly, for OpEx. So Mike kind of goes through this whole paragraph of how to come up with this number, but I look at it and say, don't overthink this. I see too many people get off track trying to account for every penny here. And my tip is just to take your real revenue number from above, subtract off what you wrote down as your profit number, what you wrote down as your owner's comp number, and what you wrote down for your tax balance. And whatever the remaining number is, that's your OpEx. Okay, just make it that simple. So now let's get to the good part. Mike interviewed thousands of financially healthy and profitable companies and found trends that we're now going to apply to your firm. These percentages are called TAPs, meaning target allocation percentages, because all firms are different. we need to convert our dollars into percentages, which we're going to refer to as caps for current allocation percentages. And again, please don't get tied up in the abbreviations and the acronyms here. If you download my Excel file for the instant assessment, this whole next step is going to be done for you automatically. But based on the table from page 68 of the book, you will now compare your current percentages to the target percentages to determine how healthy your firm is. I personally struggle with how the instant assessment does this part with a delta column and a fixed column and how those results display. So that was another driving factor for me to create my own Excel file. I simplify what the output looks like. But again, in the book, and this is on page 68 right here, and then I have a snapshot in the blog that's related to this podcast that shows you what this table, what the detail is. And again, this table that I just showed you that I referred to on page 68, these are the percentages that you're going to aim to reach. Not everybody ever reaches them. I'll just warn you that right now. But it's your goal, it's your target, it's where you want to head, it's where you want to drive your business to become healthy. So, what do these percentages and numbers mean? Okay, so we have from Mike's research that he determined healthy target percentages to be, but they're not perfect. They're meant to be an excellent starting point, a means by which to define your goals easier. That's it. If you look at the chart above for TAPS, you will see companies that are broken down into different revenue ranges by real revenue. So remember, we had our total revenue minus materials and subs was your real revenue. This chart is based on real revenue. It's the real revenue you have to operate your business, so not total revenue. Okay, so the couple different ranges that are represented on this chart. A business doing less than 250,000 in revenues, typically a one-person operation. This company should have the most flexibility to reach their TAPs because they already should have low overhead. Businesses in the 250 to $500,000 range likely have employees and they'll need basic systems, equipment, and have substantial payroll costs. So there will be a shift to increase your OpEx allocation and decrease your owner's comp with good reason, because the owner should be doing less work than they did as a solo practice. Firms in the 500,000 to $1 million range are on a growth trend, needing more systems and more people. This firm will need to invest in people and systems, but also start building a reserve for the next growth spurt once they hit 7 figures. And something that just popped in my mind after I said the last one about the 250, even though your percentages, so your percentage for owner's comp will decrease, but that does not mean the dollars going to your personal checkbook decrease. Remember, percentages are different. So as your real revenue rises in dollars, your percentage for owner's comp may decrease, but the dollars, when you do the math, you'll still have more money in your bank account. I just wanted to point that out. So a business with real revenue that's between $1 million and $5 million a year, systems are now mandatory and should be in place. No more keeping things in people's heads. They need to be documented and shared, and you have processes and checklists. It's a must. No getting around that. So, and accordingly, your OpEx is going to increase because of this need now. Your businesses that are 5 million to 10 million in annual revenue, there's typically a management team put in place now with a secondary management layer added in. Above 10 million, a company will typically stabilize and achieve predictable growth at this point, and the founder's income is almost only derived from profit allocations. So Mike shares on page 70 of the book an instant assessment he prepared for a law firm he was working with when he wrote the book. And from my experience, this is not an unusual first instant assessment for a law firm. It shows real revenue of 1.2 million with substantially low profit of 5,000 and low allocation for taxes at 95,000. The majority of the money is being spent on owner's comp at 190,000 and operating expenses of 943,000. And while your initial reaction to those numbers, I know you're listening to this and I spoke numbers, but you're looking at 195,000 total compensation for the company. And then you heard me say that OPEX was too high or that owner's comp was too high. Don't freak out. So while you may be upset, owner's comp was deemed by the profit assessment to be too high at 190,000. Consider the total picture here. With the profit and owner's comp allocations, profit first would suggest total compensation to the firm owner to be $246,000 annually, not the 195. Okay. It's just a different way of looking at this. This instant assessment is showing, for this law firm, is showing that too much is being spent on operating expenses and not enough is being saved for taxes. And here's the come to Jesus moment. A healthy business will pay taxes. There's no scenario where building a healthy business and putting more cash in your bank account will equal less taxes being paid. What needs to happen is tax planning. Finding a tax planner, not a tax preparer. Not every tax preparer does tax planning. There is a huge difference here. Finding a tax planner, someone who's an expert in planning and managing your tax bill, is invaluable now and going forward. But don't panic. I don't remember any profit assessment I've ever prepared where a business is underspending on OPEX. So don't panic. Everybody overspends on OPEX. It's human nature, I promise. This is an exercise to determine the health of your firm. Now that you know where you are, you now know where you should be heading next. And how do you get there? Again, don't panic. Mike's first book, The Toilet Paper Entrepreneur, is a great resource full of tips for saving money while growing your firm. I've had so many conversations with clients over the years. They know they're being frugal, but still struggling to manage their cash. So here's the golden nugget. Yes, you are being frugal as you buy each thing, but are you really in need of the things you're buying? Do you need an office when you always meet clients virtually? So this is the toughest chapter, the realization of how your firm may have been bleeding money profusely for so long and how much money you could have had in your bank account right now. And let that sink in. But know we can fix it because knowledge is power. And now it's time for our listener's question of the week. And the same as the last few weeks, instead of a listener's question today, there's a side note in chapter 4 of Profit First that is something I'd like to address here because I feel so many people will have the same question. And the question is, what if my firm is brand new? And here's the answer directly from Mike on page 73 of the book. How does Profit First work if you just launched your business and have no revenue? Should you wait until you have some to start Profit First? Heck no. Starting with Squat, your whole business future is ahead of you, which is actually the best time to start using Profit First. Why? Because it allows you to form a powerful habit right from the get-go when your business is forming, and perhaps more important, prevents you from developing bad financial habits that can be difficult to break. Also, in the early stages of building a business, you need to spend as much time as possible on the selling and the doing. Systems and processes come later. For these reasons, it's best not to worry about getting the exact right percentages for your business. Simply use the percentages in the instant assessment for your target allocations, but start at 1% allocation for the profit account. Why 1%? You'll find out in the next chapter. Start with 50% for the owner's comp and 15% for the tax account. Use quarterly adjustments to step up to higher percentages and nudge your business closer to the TAPs recommended in the book. As for the advanced Profit First strategies that I share in the end of the book, don't worry about any of that until your business has been active for at least a year. The goal for new businesses is to form the basic core of profit first good habits and then spend every other waking second getting your baby off the ground. If you would like to submit a question for a future episode, please send an email to podcast@profitscalethrive.com. And no, by sending us an email, you will not get added to an email distribution list. There will not be a phone call and there will not be a sales pitch. We follow the golden rule: treat others how you wish to be treated. Today's quote is from Jim 14. When you manage your day by time, you'll never have enough. You must manage by commitment. Final thoughts for today. I hope you're enjoying this approach to the book Profit First. Today, we talked about how to easily and quickly assess the health of your firm. You can download my Excel file to make it even easier. I'll put the link in the show notes. But here's your action step for this week. Do your instant assessment. It's a big action step, but it will help you reap rewards as you continue through the book. Don't think about it, just do it. Next week, we're going to talk about the allocation percentages. Please don't be discouraged or overwhelmed at this point. Whatever you're feeling, I guarantee it's normal, totally and completely 100% normal. If you need to pause here before moving to the next chapter, because this has been a pretty emotional chapter, that's fine. But please set up your profit account and allocate 1% of your income each week. I know how this seems so small and pointless, but I promise that there will be a noticeable impact on your business and you while you gain the benefit of creating a positive habit by the time you do return to the book. If you have any questions about today's episode, feel free to comment if you're watching on YouTube or send me an email to podcast@profitscalethrive.com. If you know someone who might need to hear this information, please share this episode with them, or if you're on YouTube, tag them below. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks, and have an amazing day.